Okay, and we are live. This is exciting. This is actually my first time doing a live stream. Like over a year of running a YouTube channel together with Robin, which is it's been way too long. And so excited that it is with one of the biggest names in DeFi. So grateful that you guys could make it. So this panel is going to be all about lending and borrowing, arguably, or probably the biggest use case, the killer use case in DeFi so far. These guys represent, or lending in general represents about 60% of DeFi's total value locked. So it is a giant, and here are the lending giants within the giant. So I'll give a brief intro, but then obviously everyone will have a chance to talk very in depth about their own protocols. We have Rune Christensen, he's the founder of MakerDao, Stani, the founder of Aave, Calvin Liu, the strategy lead at Compound, and Leo Teng, the founder of CREAM Finance. So welcome everyone, and I'm Camila Russo, the founder of the Defiant. Welcome everyone. So great to have you all here.
Thanks for having us.
Thank you.
Yeah, of course. So I'm gonna start out by, I want to get to know each of your protocols more in detail. So we all know all of you guys are leading some of the biggest lending and borrowing protocols in decentralized finance. But if you had to say, what's kind of the one thing that is differentiating your own specific protocol from the others? Like, why should users go to your project and not somewhere else for like what specific use cases? And Rune, I'm gonna pick on you first.
I think for Maker that's quite easy, because Maker is a protocol that's a little bit different from the other lending protocols in that it's like it is a lending protocol, but it creates a stable coin rather than a sort of a deposit lending pool. And so, for instance, that means that there's no place to kind of like deposit stable coins in Maker and earn a return. You can only really borrow from Maker, and then you can use the DAI stablecoin as a currency. But the biggest the biggest advantage of that is that because DAI is a currency that's used quite a lot across DeFi, then there's just a lot of demand for DAI that sort of is inherent to it being a currency, rather than because it pays an interest rate for some other reason. And for instance, that means that there's just a very low cost of capital, right? So you can, in the long term at least, you can often count on the Maker protocol being a very cheap place to borrow, especially when it comes to sort of the swings that you can often see in rates. They typically are more muted with Maker, just because there is always that baseline demand for the DAI stablecoin.
Right. So I guess like the main thing that's driving Maker's differentiation is the fact that it mints its own stablecoin, and so that produces a lot of effects, like maybe cheaper borrowing costs and other things. The deposit rate for DAI is kind of like also what is kind of like setting rates for the entire space as well. And okay, so what about for Aave, Stani?
Yeah, definitely kind of like where I think what Rune explained and Maker is kind of like a issuance market of let's say interest rates and debt. Aave is more of a kind of like a secondary market where we actually have like multiple stable coins that you can borrow. So we have essentially an interest rate market that you come and deposit. So that's like the functionality that like a secondary lending market protocols have. So you have like a two-folded market where you have liquidity providers coming in and earning yield and governance power at the same time, and also kind of like you have this ability where your deposit becomes essentially a collateral, and then you can draw another asset from the protocol. But for us, what's fascinating is that Aave is a protocol in the sense where we have multiple markets. So we essentially, as a community, kind of like a package the risk in a certain way where we can create new markets. For example, we have a AMM market where you can use Uniswap liquidity provider tokens as a collateral, and balancer tokens, liquidity provider tokens as a collateral, and implementing other LP tokens as well. And also kind of like we have this cross-chain compatibility that we are already deployed in Polygon, which is essentially another market of what we have, and different kind of asset composition. And I think like maybe like in terms of like features, we have pretty much like flash loans that is available to draw from the protocol, which helps in terms of developers who are building composable products for refinancing or liquidator bots. But also we have other features where you can actually close your loan position with the collateral itself, or you can swap your collateral from one position to another. But essentially, I see like all of the protocols are one way or another just pretty much like packaging risk in somehow, and just as a community, kind of like selling different kinds of like risk parameters within the community. That's kind of like my thesis, how every protocol differentiates from one another.
Interesting. Okay, so I guess to summarize, Aave is trying to create more complex markets with like derivatives of tokens that can be lent and borrowed and used as collateral, for example, LP tokens. Also, this ability to deploy flash loans, but yeah, like the overall sense is that how each DeFi lending protocol will differentiate is in the way it packages risk, which is an interesting take.
Yeah, I guess like how the community lists different assets and where they are comfortable in, and that's like pretty much like differentiator for across like DeFi, I would say, in general, what I've been observing.
Colin, what do you think about that?
Yeah, I think that's a really interesting framework. I guess I guess so. I think like fundamentally, like a lot of the sort of interest rate marketplaces or lending protocols are very similar in that, like very simply, they let a user provide collateral to borrow assets. If they borrow assets, it generates an interest rate, and then that lets people just provide collateral, provide assets to earn that interest rate, and in that way, there are these interest rate marketplaces. And then I think what Stani's kind of getting at is like they're starting to be, like many of these are just a couple years old or even less. There's starting to be all these nuanced differences in various like parameters of these protocols, like selection of assets. Every asset has a different sort of risk profile, and the way that each protocol assesses those risk profiles is different. Slightly different economic parameters. So for example, like the interest rate algorithms of each of our protocols, even for the same asset, is probably slightly different. Maybe some of them are the same, maybe some of them are different. They have different economics around like token rewards or sort of like liquidity mining, like whether it's Comp or Aave or Cream. And then yeah, now different protocols are going to different chains as well. I think like so that's sort of another way to look at it is like each protocol has its own history and trajectory that has created like a culture of basically risk tolerance is a way to put it. Not risk tolerance, but just like approach to risk. Not that some are necessarily more risky than others, But I think like Compound's community and culture is probably more on the conservative side, like makes decisions very, very slowly. And it's something that we've encouraged from the very beginning. Like we think that having a very thin functional layer of interest rate marketplace will be attractive for developers to build on top of, instead of having the very like fully featured sort of like thick, more vertically stacked platform for developers to build on top of. And then one other sort of nuanced difference I'll point out that I don't think has come up yet is just the utility of the tokens of each of the protocols. So like on Aave, you can stake it as a backstop for security of the system. Compound is governance only, but I think Compound has like a really robust on-chain governance, like governance system driven almost largely by on-chain actions and transactions, which is really interesting and differentiating.
Yeah, like you brought up two different frameworks, the kind of risk profile that's kind of driven by community and the trajectory, and also how the token is being used. And so while Compound is on the more conservative side of the risk profile, Leo, would you say CREAM is like on the riskier side?
Yeah, I do think that is a big differentiation for CREAM. I think for at least what we've been calling the CREAM V1 markets, which there's a bit of, since our merger with Yearn Finance in November, we've created the Iron Bank with Yearn, which is a separate, also from a risk standpoint, a little bit less risky than our CREAM V1 market. So I think in terms of differentiations there, I think there's two directions to talk about for us. One is on the Iron Bank side, we're focusing on the protocol-to-protocol lending. So recently we're looking and developing into the DAO-to-DAO lending side as well, which are areas that I think I'm assuming most lending services are also exploring, and that's super interesting to us. And then for the CREAM V1 markets, we mentioned earlier, definitely we offer the widest selection of tokens across the widest set of stable coins, as well as other major or governance tokens, in addition to liquidity provider positions. And as such, users can end up expecting higher yield, and so therefore we are further out in the risk spectrum. But in order to account for the additional risks that the users could be taking on, we had to come up with additional safety features like collateral cap to control for the risk of these long tail assets. These are features that the other protocols here, as far as I know, haven't implemented, but they don't also need it as much as we do because we are further out in the risk spectrum. So I do think that as we experiment and look for differentiation in the marketplaces, although we're, as Calvin said, largely doing a similar thing, our approach is different, and I think that's actually super exciting. But generally, yeah, it's as Rune mentioned earlier, Maker is a bit different than Compound and Aave and CREAM in that way that we have just a possibility of a variety of things in for a variety of things out, whether that's stable coins or other tokens. But I think all of these approaches are all very interesting in themselves, and very excited to see how they all play out.
Awesome. I don't know. It looks like Stani dropped off. I think he's back now. There we go. Stani, don't leave us. Actually, I have a question for you. So I saw that there were a couple of breaking news on a couple of your protocols here, that I, as a good journalist, I'm not burying the lead and waiting till the end of the panel to ask. So Stani, you tweeted yesterday that a new version of the Aave protocol is in audit. So would love to hear more details on that. What are kind of the main changes of the new version of Aave?
Well, yeah, there's two kind of things that we have been working upon now quite a lot. So obviously there is kind of like a update of the protocol that we have now, the new version. And also like separately, we've been working upon the so-called Aave Pro market. And maybe the Aave Pro is quite easier to tackle. So, well, let's say the new version of the protocol is kind of like a more risk-centric update. Probably the kind of like a biggest towards that direction. So there's different kinds of functionalities on supply cap, borrow cap, but also this interesting innovation of exposure cap. So practically, it helps us to go towards a direction where the protocol itself can list wider amount of different kinds of assets. And in tied to that, there's a kind of like a risk admin functionality, which allows to create additional kind of like a risk assessment tools and functionality for a risk DAO. This essentially has kind of like an oversight of different assets if market moves very quickly in terms of like what kind of parameters there are. And then plus on top of that, it's easier to implement dynamic risk parameters into the new protocol. So essentially kind of like we're going towards direction where we try to reinforce the protocol as much as we can, and at the same time move towards a permissionless listing model of new assets. And essentially after this update, I think the Aave team will not kind of like build more functionality of that protocol, but essentially the community will take over the development, and there will be a developer DAO, which any developer can actually apply to and continue building that protocol. And at the same time, we've been building this Aave Pro market that we call actually today Aave ARC, ARC. And the idea of that is that we can, as a community, create private markets where you have this kind of like a whitelister functionality as an admin that can add and whitelist depositors and borrowers and liquidators, essentially creating kind of like a private pools. So you can have different kinds of asset combinations, but also you can create a institutional market where, for example, the custodians can act as a whitelister and add, for example, participants that has to go for certain requirements, which might be, for example, compliance. And that way, we kind of like deploy a institutional market that is governed by the Aave community in the sense that they're providing the risk parameters, but at the same time, there is this kind of component of whitelisters that are actually providing the depositors, borrowers, and liquidators in those markets. So it's interesting kind of like involvement in the technology that we have at the moment. So that's what we're working now, and a bunch of other things, but at least like that's
the highlights. Yeah, is that very kind of, is that Aave 2.5 or 3?
Well, it's hard to say. Like we're still fighting over it. Like we're still fighting. Like what it is. Like it's because the thing is there's so many updates there, but you know we don't bring anything like flashy in sense of like.
I mean, Aave
features.
Pro is pretty flashy, I would say.
It is, yeah. Aave Pro is very flashy, but yeah. The basis itself, like the new updates in the current Aave, they're very much risk because I think kind of like we just need to ensure that the protocol is as kind of like resilient as possible, especially now that I mean it was a year ago when you know all the DeFi protocols, I mean they had millions of value locked in, and now they're in billions. So it's just the risk and stakes are so high. So this is where we have to actually focus on in terms of building. But after that, we will build something more flashier. I promise.
I would love to get some of you guys' reactions to this. I think Leo, I'd love kind of your thoughts because it looks like new Aave will compete more directly with Cream in allowing kind of a more permissionless, you know, adding pools in a more permissionless way and kind of like expanding the offering of tokens in the protocol.
Yeah, I actually think that, well, so we were also discussing whether a permissionless pool of a lending market is a good idea and the various approaches in the market today. I think the idea of having whitelisting and with admins is an interesting one we've considered as well. I haven't actually, dug into, as I don't think it was publicly released yet, or maybe it hasn't, the details come out yet about the how this approach is different than something like what Maple Finance is doing with their delegators. We've considered something like that as well. I think overall, I would say that competition, however you want to phrase it, is really between the set of folks here and the traditional finance infrastructure rails, not exactly one where we're like hitting each other up kind of way. We're all trying to bring more DeFi users in the space. So I definitely think it's interesting to explore how each of the protocols may approach these problems. Similar to the risk DAO thing that Stani talked about, I really think that's a good idea as well. We have instituted our own listen committee. We're calling it risk DAO listen committee. Basically having somebody, qualified folks within the community to come and think about the risk, think about the kind of the token markets that we should be adding or removing if that's the case, and then what are the right parameters around collateral factor and things of that nature. So I think directionally where we're going is similar, and the kind of institutional markets segment type of approaches too. We have been working on something of an institutional pool as well, where we can have institutions effectively get into some whitelisting so that there would be further ability to integrate with the traditional financial rails. I think that our approach there is, in my opinion, probably different than the Aave approach, and definitely excited to see how they compare once they go live. And I think that'll be very interesting to watch. But definitely congrats, Stani and team, for the new release in V2.
Yeah, very cool. Calvin, I'd love your thoughts on kind of the institutional side of DeFi. Compound recently released Compound Treasury. So if you can kind of talk about that and talk about how you expect institutions to start to interact with the space.
Yeah, totally. First of all, just to react to Aave ARC, I think it's fascinating. I think it's really interesting. It's something I've personally thought about a bunch. I think when you talk to institutions, many of them just require, they're basically saying they require an ecosystem like this, where it's like permission and whitelisted, KYC, AMLs, whatever. And I thought for a while that all you would need, not all you would need, but if you had a stable coin, probably a centralized stable coin, unfortunately, and an AMM and an interest rate marketplace and an ecosystem where every user was KYC'd and accredited, or an institution or whatever, you could have a pretty interesting self-contained little economy where you could then have securities. Like maybe if like Carta or some other private share management company built this, and you could borrow a stablecoin against your shares of whatever startup you work for, and then go and LP like shares of, I don't know, Facebook and Google somewhere on AMM. I think that would be really interesting. But I think, I think the longer term sort of my hope and take actually might tie in a little bit with something I saw Stani tweet like months ago, or maybe weeks ago. Time just blends together. When Aave Pro was first announced, which is, I think Stani described it as like training wheels for institutions or something, or like training grounds for institutions. And so I think like we thought a little bit about this permission pool things and permissionless pools thing. And then, at Compound, we have limited resources. So which direction are we going to lean into? And what we believe is that at the protocol layer, like these are just technologies. These are sort of like autonomous, algorithmically driven, smart contract powered protocols with no humans in the loop that I hope eventually get viewed more like Ethereum and Bitcoin. The Ethereum network and the Bitcoin network get viewed. Like you don't really, like maybe it's just kind of too big to do this at this point. Like these networks have broken out, but these institutions will use Ether and transfer Ether around on this network, on a permissionless network. like you don't have to KYC every single.
Oh no, Calvin dropped off. Okay, hopefully he'll be able to get back on soon. I was so interested. Okay, there we go. Here he is.
Yeah, it kicked me, but
That's so weird. Okay, we're back.
So yeah, what I was saying is like, yeah, these institutions are willing to use these permissionless networks as long as it fits into a framework that they kind of understand. So I think there's going to be a little bit of a journey of defining what a protocol like Compound or Aave or CREAM or MakerDao really is. Like, I don't think I want it to fall into the camp of like a financial services thing. I think it wants to be a technology layer on top of which financial services institutions can be built, like other internet and technology protocols. So that's kind of, I think it's a reasonable transition to talk about Treasury, because Treasury is our centralized attempt to build a financial services business on top of the technology that is the Compound protocol, where we're saying like this is itself a financial institution. Anybody else could actually build it without any really, we don't have a technical or economic advantage over anybody in building Compound Treasury. We have a little bit of a brand advantage and like a knowledge advantage, but really anybody could try to build this business. And what we want to do is basically take Compound and DeFi to users and institutions who really don't know much about crypto and don't want to know much about it. If you just have dollars, you can access some of the benefits of the USDC market on Compound with all of your exposure to it measured in dollars. You don't have to worry about USDC, you don't have to worry about CUSDC. We've built kind of a stack of business, legal, compliance, money transmission, etc., other layers that make it so that you as a user don't have to care about those things. You just know that you can get a high interest rate on your dollars.
And the difference from just like going to Compound directly and not Compound Treasury would be, I mean, I saw it was like this like 4% kind of guaranteed rate. Is it that plus like it's a regulated deposit? Like what's the difference from going to Compound directly?
Yeah, the way that I kind of like to describe it is like the app that our team built, app.compound.finance, is still largely the most popular way people access the Compound protocol. And when we built it, we said like, okay, what we're trying to do is build an example of a great application that can be built on top of the protocol that makes it easy to use. And Compound Treasury is the institutional version of that. How can we make using Compound as easy as possible for these large institutions? And when you're talking about institutions with hundreds of millions or billions of dollars, like they need so many sort of institutional risk and controls things in place. They're never gonna manage their own private keys. They're never gonna like, not never, but for a long time, they're not gonna, most of them have a very rudimentary understanding of even like blockchain. So like they're not gonna use MetaMask, they're not gonna use Ledger, they're not gonna custody their own assets. So how do you just make it as easy for them as possible? Well, we'll just put all of that hard work into Compound Treasury, which is basically their interface for Compound. So really, like the customer we're targeting is not someone who even knows how to use app.compound.finance, and it's someone who doesn't know how.
Will be cool if Compound Treasury uses also the Aave protocol. Someday.
Yeah, someday, it'll be interesting as kind of a standalone business. There's a future in which it's like a DeFi prime brokerage, kind of like a way for institutions to use various DeFi protocols. But we'll see. It's very early. We announced this thing 3 weeks ago.
Yeah.
With this one single product, and we have ideas for future products. But.
So how's it going so far? Like, what kind of demand are you seeing? Can you say like how much is in Compound Treasury at the moment?
Yeah, I don't think I don't think I can drop any numbers. The customer demand, as the reception has been phenomenal, I'll say, and we have a very robust customer pipeline that we're working through. So the reception has been phenomenal. I mean, just as an example, you know, I think a few years ago, I forget who it was, I think Wealthfront offered like 3%, or Robinhood offered like 2.5% or something for like a few weeks, and you know, it like dominated headlines around the world. So we're offering 4% in a way to make it easy for non-crypto users to access, and I think we're receiving like, you know, a reception that's sort of, I mean, we don't have millions and millions of users, but a comparable reception relatively.
Nice. Rune, how about for Maker and its integration or relationship with institutions? Like what are the ways, or what are kind of like the offerings that you expect will be able to draw institutions, or maybe that's not even kind of a priority?
Well, so Maker is kind of an interesting case because, I mean, it's a very old project and it started out quite, let's call it sort of Wild West. That was the approach that we really took early on, and really saw that was DeFi, what DeFi really should be all about. And over time, it just, I mean, you know, we just learned more about the space and sort of the industry and the market for all of this stuff. And it quickly turned, well, maybe not quickly, but over the course of years, it turned out that Maker, as it's sort of the way it's designed as a protocol, is actually a lot more appealing, basically, to like institutions and relatively large users who can then actually often pass on, you know, their access to the Maker protocol to their own users. So basically, Maker has had, I guess you could say, something like a kind of use case that's equivalent to something like Compound Treasury or this kind of approach for years, actually. Like a fun fact is that most of the time, something like 50 to 60% of all DAI generated with ETH as collateral comes from like 5 entities. So like 5 users, basically, they drive more than half of all of the borrowing demand. And it's like the number one borrower of all on Maker is Nexo. So that's like this traditional sort of CeFi protocol. So basically what they're doing is they're, you know, they're borrowing money from their users, and then they turn around and sort of like lend it to, you know, they borrow money from Maker, and then they turn around and basically lend it to their users. And other various CeFi protocols as well. And then also like funny sort of like, you know, I wouldn't call it an institution, but you know, Yearn is like an interesting case, right, where you have an automated protocol controlling this massive Maker vault that they use to run their strategies with. And from the perspective of Maker, these kind of users are great. We love them because they're extremely sophisticated, and they actually run with quite high capital efficiency. So they're quite close to the limit of how risky you can keep a position in Maker. But it's never a problem for them because it's a 24/7 fully automated, you know, high security operation that just makes sure that they always add more collateral and they always sort of balance their position correctly. And it's just like a very stable and sort of like reliable source of you know, demand for the system's services, basically. But in sort of the broader sense, so this is sort of one thing, is like this is sort of the classic use of the Maker protocol by I guess you can say large users or entities. And one new approach that the community is actually considering is to set up these like privileged vaults. So basically, the Maker community what might actually happen is they'll go to these 5 super users, or maybe those, you know, maybe the top 10 users or something, and then actually offer them like a special deal saying, we'll give you like better rates and lower fees and like all sorts of like better parameters based on the track record of like managing the, you know, having these automated systems set up that show that they're really good at keeping their position secure. And then there's sorry, go ahead.
Sorry, no, it's like an internal kind of credit score system of sorts.
Yeah, I'm actually, it's not totally clear yet. It's more, right at this point, it's more like an ongoing discussion. I mean, it was basically Nexo that a while back basically came and proposed, they're doing a lot of volume, right? They're the biggest user. They wouldn't mind getting some even better terms, obviously. And the Maker community is taking that very seriously because, of course, they want to make sure that they keep Nexo happy. And then they're looking at sort of different approaches. Another could be something like, I guess something like Nexo, right? That has like their own Nexo token, or Celsius, which is another example, right? They have like a Celsius token. They might also be able to collateralize that on top of the ETH collateral, the Bitcoin collateral that they use, or just some other sort of more sophisticated solution that follows this trend of kind of like providing extra services and extra sort of deeper integration with users that are just very large scale users of the system that provide a lot of value to the network. But the sort of the really interesting path that I think all of DeFi must take, that to some extent is also sort of institutionally focused, is moving towards real world assets, right? So not just lending out to institutions that come with some Bitcoin or come with some ETH, but actually lending sort of in the traditional way, right, based on real assets in the real world. And that's something Maker has. I mean, I've been for years. That's sort of been my tagline, right? Real world assets are coming, right? I've been saying that for like 2 years or something at this point. But about 2 or 3 months ago, Maker actually did the first ever funding of like a real estate business, so like an American real estate lender that actually, through a platform called Centrifuge, set up a system where they're able to collateralize real estate assets into the Maker protocol and actually generate like brand fresh DAI on this collateral that they can then go out and actually turn into US dollars and lend out. And all of this is in a fully compliant, fully regulated manner, basically, that I think is quite interesting. It's still very small scale, but what we've seen is it's kind of like the floodgates have opened now, right? So there's just this massive amount of interest from other real estate lenders and trade finance companies and renewable energy companies, and they're all sort of jumping into the community and just trying to get set up and basically trying to establish themselves as one of these to some extent it's like an intermediary almost, right, that borrows from Maker and then turns around and lends it out elsewhere. And that's it wasn't exactly the what people expected from Maker when we first started out many years ago, but over time it's really proven to be that's the right fit for Maker, to be this sort of central hub that then lends to other places that can then sort of take care of the actual sort of distribution of the credit to the end users.
Makes sense. It's an interesting approach to institutions. It's so on the one hand, there's like these permission pools that Aave and CREAM are looking into, but then on Maker side, it's more about opening up the protocol to institutions by way of providing like a different type of collateral. Like, so before, like right now, most users in DeFi are those with a lot of crypto. So you're opening up the space for people who have real assets as kind of their way of earning, like putting collateral in this space, and that just like opens up the space to like all these other players that haven't been involved as of now. But it hasn't been without controversy for Maker, right? There's this, a lot of people are saying Maker is becoming more and more centralized, DAI is becoming more centralized. So I know kind of the argument is this allows DAI to scale, right? But like maybe if you can address kind of those criticisms.
Yeah, so I think it's kind of funny that there's a lot of talk about, specifically the fact that Maker right now is the world's biggest user of USDC, right, with something like 3 billion USDC sitting around. And that's, it's not really surprising that it's attracting a lot of attention and criticism as well, right? Because it's not really, it's pretty obvious that that's not supposed to be sort of the end state of the system, that most of the collateral are just dollars sitting there and doing nothing. But but from my perspective, as someone who's got a good overview of sort of all the different things that the community is doing right now, what's funny is that I actually see the 3 billion USDC sitting in Maker right now as sort of the biggest advantage of the system. Basically, as I mentioned in the beginning, the whole thing about Maker is that it's sort of its lending product. I mean, it's the deposit equivalent product, right? It's just a stable coin that people use as a currency, right? So what that means is the reason why there is that 3 billion USDC sitting there is just because DAI is so popular that people are actually willing to like pay money to get access to DAI, right? So they're basically lending cash essentially to Maker at a 0% interest rate right now, and on top of that, they're actually paying a little bit to be able to do that. So what that means is that there is a potential for incredibly good unit economics when it comes to allocating this capital out, which means that it's possible to do these sort of very low risk and just sort of solid deals with things like very low risk and secure real estate, for instance, or also just like more high margin activity. So basically borrowing really cheaply and then lending it out at a higher rate with a bit more risk, which I mean, a great example of that is actually something called the D3 module, which is like a direct. Yeah, I'm sorry, Stani, I can't remember the order of the words, but it's something like
direct deposit module, 3M or something.
Yeah, the DAI direct deposit module or something like that. So it's this community initiative that actually was pretty cool, with Stani coming into the Maker forum and the whole community getting like rallying around this. And the basic idea is the Maker protocol lending out some of its capital on Aave. And potentially multiple different Aave markets, because there is this Aave does have this sort of diversified approach where you can sit and sort of choose different types of markets that you want to lend to, and that's that's basically a way for Maker to earn a really nice spread, where if Maker is able to lend to Aave at 3%, and when it's borrowing itself at 0%, that's just like instant profit right there, right? That's a really good deal, basically. And that's sort of the solution to get past having so much USDC just sitting idle. It is basically figuring out what are some scalable ways to really deploy it, and also diversify the collateral.
Yeah, makes sense. I'd love to give a chance to you guys to ask each other questions. So breaking up the moderator-led panel for a bit, and I'm sure you guys have questions for each other. So go ahead, take it away.
Yes, I have a question for you guys, and I think it might be a little bit different from the perspective of like secondary market or like secondary lending protocols, but basically how you view sort of how interested you are in doing things like over collateralized stock lending, for instance, right? That was mentioned earlier, right? Of like someone takes $2 million worth of Apple stock, and then they borrow $1 million worth of stablecoin and use that, and that's sort of one way to deploy capital, right? So like deploy capital into an over collateralized sort of margin position. And then another approach that Maker has recently started focusing a lot more on is basically doing these more like structured deals. So something like, giving a $5 million line of credit to like a real estate company that will then pay 3.5%, or there's another deal that's Maker's about to do, which is putting $15 million into a trust into Delaware Trust, and then having that being used to finance construction projects, also at a sort of like a more fixed rate that looks a lot more, looks like a specific type of sort of structured traditional finance deal. So I'm curious what you think about how that whole landscape will look like in like with the DeFi twist.
Well, I can say that we take a bit, what we have in mind is a bit like kind of like a similar approach, but like taking liquidity out from DeFi with this like credit delegation system where, let's say, you could create as a community, or maybe as some sort of like a traditional financial institution, or some sort of like a entity, a smart contract based vault where you get credit delegations, which means that the Aave depositors can choose to delegate borrowing power to you. And then you as an entity, kind of like you have this trust relationship where you pay more premium, but then you use this DeFi liquidity to, for example, to fund activities or money lending businesses in traditional finance. So kind of like that perspective is what we have been thinking about, and maybe kind of also like waiting for developers and other like protocols to somehow like take this feature and just use it and try to build this functionality that crosses between like TradFi and DeFi. So that's what we've been looking quite a lot, how we can like integrate more in the TradFi finance.
So I have a few thoughts. One is that I think I personally and historically at Compound, I think we tend towards wanting to build tend to like things on chain as much as possible at the protocol layer. And so, I think like once you have decision making that's kind of off chain about the extension of credit or structuring of deals, I think it can get just a little bit messy. Like I'd almost say maybe it's just not a problem that that we want to focus on as primarily engineers. Like it's a less mechanically solvable problem, I guess I would say. And I think that the over collateralized market is still early and big enough to be interesting while satisfying that sort of desire to keep things as on-chain as possible, at least with respect to the Compound protocol. I think like, if you go on CoinMarketCap or CoinGecko, there's something like, I don't know, 1.2 or 1.5 trillion dollars of crypto assets that they track. And among our protocols, there's, I don't know, maybe like less than $50 billion of assets that are being used as collateral. So I think there's still a huge opportunity just to focus on the over-collateralization market, especially as, the market cap of crypto, which is basically usable collateral, is growing exponentially over the past decade. And then a sort of separate point is, I haven't thought about this super deeply, but I think that there's like sort of an incentive mismatch when, at least today, when trying to take these DeFi first products and then start to compete with TradFi offerings, like in many ways just extension of credit, which is requires like a lot of trust and or like analysis of off-chain finances. And what I mean is that I think a lot of protocols, especially in the credit extension space, fall into this little trap where the customers they want are the ones that can get incredible deals outside of DeFi today. Because that system is so mature that that they don't have to come to DeFi. Like if they come to DeFi to get a deal, it'll be a worse deal than what they can get already. And so, so you end up with only the worst possible customers coming to DeFi to source these types of deals. I think is like a potential pitfall.
That's interesting. And that kind of leads to semi-related to I wanted to get to some of the questions in the comments, and Leo and Stani, if you have like other questions, or Calvin as well, for the rest of you, feel free to jump in. But yeah, we have 10 minutes left, and when I get to some of these questions here, so let's see. I think it's interesting that this comment somebody made earlier, saying that credit scores completely defy DeFi, and DeFi should be only collateral based. Wanted to get your thoughts on that. I think kind of I, for one, would be looking forward to a moment where that's not the case, and more people can access DeFi and take out loans without needing so much upfront capital. But does that go against kind of this like permissionless way of doing finance?
I think. Leo, go ahead.
Oh, that's not. Yeah, say I actually think that credit scores, depending on how you define it, is one way to think about it, right? So if you think credit score like, bad, traditional credit score from the traditional finance world, the Fair Isaac score, that's broken because I moved from the U.S. to Taiwan, and then I got I have an established credit history here. So depending on the jurisdictions you're in, that score doesn't carry through. And in an increasingly globalized world where people do move around, even if temporarily because of COVID reasons or whatever else, we have this lack of the ability to measure that. And that's just TradFi problems. We haven't gotten a DeFi piece yet. But I think in order to say that DeFi credit score has no place in DeFi, perhaps means that particular credit score system. But I do think that it's valid to say if you could able to draw out behavioral patterns based on particular wallets, to say if this wallet, and let's say 10 years from now, this wallet in the last 10 years have never defaulted on any loans, you probably want to treat that wallet with preferential treatment, or rather it's less risky than any other wallet. And I think this also in fact comes to the whole inequality question within finance. You have this idea that somebody has a gazillion dollars trying to make $1,000 loan for some reason. That person's going to get great access, roll out the red carpets, get the free champagnes and all this stuff. And somebody who's like, look, I've only got $1,000 of borrowing power for whatever reasons, but this is like my one shot to make it big. I'm going to launch this business. So in DeFi, any of these protocols we're talking to, that person with the collateral that wants to borrow $1,000 should be able to do so without any kind of what school did you go to, or where you live, or who do you know? And that kind of on-chain pure risk type of design of credit score system, I think that's a good idea. I mean, actually up to see how the communities end up, but I think that could create a more equality within the financial system. In fact, if you can, in fact, say, look, I've built a really good credit score on my address, and then now wherever I go in the world, this is going to follow me around, and I don't have to deal with the existing broken infrastructure, which does not do that for me.
Yeah, and I have to say that, first of all, Leo, your hair is very amazing. But I have to say, what Leo said is absolutely correct in the sense that everything is collateralized. It might be on reputation instead of, let's say, cryptographic assets that are very liquid in the DeFi ecosystem. And I think we underestimate as well how much actually data and the transactioning on chain and the traces, the provenance that it leaves, actually can become a very fascinating credit scoring instrument, where you can actually determine which kind of addresses could get based on what kind of holdings of assets and let's say non-fungible tokens such as art or whatever access it might be. And that provenance itself forms interesting footprint or identity, and could be used in a way to obtain credit. So I guess it's just like when we are looking at credit systems, we fairly often fail in the sense that we think that normal loans that are in TradFi, let's say, they aren't collateralized, but there's always something beneath it. And what's in TradFi happening, you have the system where you have kind of like a enforcement of loans. So let's say if you default on a loan, there is some sort of like a consequences legally, but that hasn't been always the case that you have to somehow legally repay. You might lose your name if you go hundreds of years back, like your reputation. But the similar reputation is something that you can create on chain, and losing that will be very, very kind of like unfortunate, and it has a value and stake as a whole. And it's part of like seeing data and everything you do on chain, the footprint as a concept of I would say like identity, but maybe like a collection. You know, if you have a defaulted loan that breaks your collection, and then you know it's not the same anymore. And especially when the data is on blockchain, that means that you know that data is there and it's not going to disappear. So I think like we're not close because of the fact that we don't have enough like different kinds of data on chain. But I think we're moving closer, especially with NFTs coming in and actually kind of like showing what people like to bid on and obtain as NFTs, and what kind of protocols people are interacting. DeFi score is just one of examples where you know you have some sort of like a data attributed to your transactioning.
I wonder if like CryptoPunks owners will get a better credit score than, I don't know, someone who doesn't own some sort of OG NFT.
If you collateralize it, yeah.
Okay, so interesting question coming in, and I think it'll be one of the last ones, but this question of returns versus rewards. And I think it's interesting today because of all the just like crazy yield farms that we're seeing popping up every day with like 1,000,000% APYs and whatever. So for especially for someone who's just getting into DeFi, and they're maybe, you know, going to Aave or Compounder, any of your guys protocols, and seeing, okay, I can lend DAI at, I don't know what the rates are right now, 4%, whatever. Or I can go into X yield farm, you know, .io and earn 1,000,000% APY. But so I think that might be a bit dangerous for especially newcomers to the space to conflict the two things. What are kind of your takes on that, and like how can people be safe in this space?
I think I want to jump in here and say that as a protocol who started up basically serving the apes in the degen space last summer, I think that, yeah, it's exactly that. It's a balance. And sometimes the safest way to think about it is that with all these farms, like what we saw last year too, was that we had created the markets for these tokens that weren't served in anywhere else. And you can actually capture some of these premiums by actually just supplying these tokens so that the other degens can go ahead and play those degen games. That's one way to get yield. But in terms of balancing, so I think that's true with all of our lending protocols here. If you can actually lend out these tokens, that's one way to actually access some of that high degree of rewards without actually being in the risk itself, because somebody else is collateralizing to borrow that token. So you can't, you know, lose it that way. But another way to look at it too, I mean, for any newcomers, if the angles that question, newcomers coming in, I definitely think that, you know, you want to look at some of the tools that exist today, right? Like Immunify has good bug bounty programs. If you have a system that has good bug bounty programs, that's going to be helpful. If you have DeFi safety, you look around at kind of, are the code written well, documentation, and all these kind of standard coding safety things, at DeFi safety and other services like that. I think it's good to do your research for sure. Everybody always says do your own research, but I think balancing out risk and reward is definitely a personal question for most. But at the same time, I think some of the old adage that people talk about a lot, like don't put in more than you can lose. Like every time I ever ape into something, I kind of back my mind, there's a little voice saying like, hey man, you may never see this money again, but just know that going in. And if you're okay with that, maybe that's all right. But also, I think I'm curious what the other folks here have to say about that.
Yeah, so actually, as someone who doesn't offer a lending protocol, you know, people very often ask me like what to do, how can I do DeFi but stay safe. Actually, you know, I think it's a really good, it's the right group of people you've gotten together, Cami, because it's basically Compound Aave, and then the Compound Aave, that's like, if you want to be safe, then you go to Compound Aave. And then CREAM, that's if you want to be risky, but you, in exactly the way Leo described, right? You kind of want to take some more risk and you want to get some better returns, but you don't want to literally hold the hot potato yourself, right? You still want some protection around you. And I mean, it actually does well. So Compound Aave and CREAM, they do all have yield farming themselves, right? So the whole question of sort of returns versus rewards, even then, it's not like I think a better way to think of it is basically, how, what's the risk for the reward that you're getting, right? And there are certainly, it's, like there's sort of an old saying, or I remember hearing quite often, right, that when the central bankers, they go out and warn people, they say something like, if you're getting more than 7%, be prepared to lose everything, right? Like that there's some thresholds where there's a certain level of return where the market is basically saying this thing could absolutely explode tomorrow, right? And it actually doesn't take that, once you're in the double digits, you're pretty much there already, at least according to the traditional way of thinking. And I think actually in DeFi, I mean, yeah, like you really see a lot of like hacks and weird things happening. So yeah, that's why I actually always tell people, stick with the big ones. Sort of like go to DeFi Pulse and look at the top ones and only use those, right? And if you're sort of in a position where you should use anything else, you shouldn't even be asking me this question, right? I mean, then they should do the research themselves, basically. And for, like, TVL gets a lot of flack as a bad metric, right? But it is actually a really good way to think of in terms of, like, if you don't know what you're doing, that's kind of what you want to follow, because that is actually to some extent is a measure of like safety.
Yeah, I mean, I would also add there TVL, but also weighted, I guess, by the how long the protocol has been live, because like we've seen projects kind of jump to 2 billion, 3 billion TVL in a day, and then like crash and burn 2 days later. So I think it's like how long a protocol has kept their multiple $100 million, billion-dollar TVLs without huge exploits. Unfortunately, we are coming up to the end of the hour. I had so many other questions. We didn't even get to layer 2s and like multi-chain. So I don't know, maybe we'll have to do a version 2 of this panel. It was so interesting. I just wanted to end with like one quick fire question for all of you. Keep it brief. I just what's the most surprising or interesting thing, launch, feature, whatever, that users can expect from your protocols in the next couple of months, either from your protocols or that you think will come from the lending space in general. And yeah, we'll start with Rune.
So I mean, it's almost like a conflict of interest for me to highlight this, but the Maker protocol, like the Maker community, is in the process of onboarding staked ETH from Lido as collateral, which I think is pretty exciting, because it means you can now use a pretty safe asset that actually generates its own return, and then borrow against it in a way where you're basically making money to borrow to some extent, as long as the stability fee in Maker is lower than the rate of return that you get on the staked ETH. Now I'm also an investor in Lido, so I just have to sort of feel like I have to add that there. But yeah, like, even if I wasn't, I promise I would still be very excited about this.
Nice. Stani?
Yeah, well, of course, like we're building the new versions of kind of like the Aave protocol, but I think what's I'm very fascinating about is to see actually what Drew mentioned about the DTM kind of like a module, because it's pretty much like a collaboration between the Maker and Aave community to pretty much kind of like bring more liquidity into DeFi in the sense that it's direct kind of like advanced creation of the DAI into the Aave markets with collateralization of the ADAI tokens. And that's kind of like a very fascinating to see like how that will affect the kind of market, and maybe also like the positioning of DAI and the liquidity in Aave. But I think that's very fascinating, and I think we started to build it quite a few months ago, so it's becoming more reality. And I'm very excited about that at the moment.
Nice. Leo?
Yeah, so I think for the Iron Bank, that's where a lot of our kind of most, interestingly enough, a lot of our experimentations go on there, and we're definitely harnessing some of the benefits in DeFi, like the transparency and automation. These are two things that we've been thinking about a lot. And in terms of expanding our Iron Bank whitelisting is super interesting here. We started out with basically saying, okay, only smart contracts to know exactly where things are going, like Urine Vaults or Alpha Homora. That's when we can say, look, we know where the code's going, so okay, let's trust that. And now we're expanding this into other things, like actually it's fun to mention here, the Pleaser DAO loan that we're doing with two of the other panelists here, Stani and Calvin, also in Pleaser DAO. That direction where we can go toward exploring both NFT lending, NFT-based NFT collateralized lending, as well as DAO to DAO. I know DAO to DAO is kind of an odd definition, but I think of Pleaser DAO different than like a protocol DAO, like a Urine and Maker kind of DAO to DAO lending. I suppose they kind of work the same in the similar way, but the idea that exploring the whitelisting and where protocol to protocol automation or DAO to DAO type automation can occur, I think that's very interesting exploration for years to come.
Definitely. Okay, last but not least, Calvin.
Yeah. So I think Gateway, Compound's Gateway, and Compound Cash is probably the next sort of big thing to look out for. And really, the summary is, we're trying to build multi-chain Compound. And I think what's really exciting to me as a non-engineer and as a user of a lot of different crypto projects and products is I think historically the Compound team has shown an ability to build a really great product from through the whole stack. So great smart contracts, great application on top of it, great user experience, docs around it. And I think to do that for multi-chain is a big challenge and an opportunity. I think right now the user experience of going multi-chain is so tough that if we can solve it alongside building a really useful product, which is multi-chain Compound, it could be really impactful for the space.
Yeah, a usable or user-friendly multi-chain DeFi would be huge. So yeah, also looking forward to that. Great. Okay, this has been amazing. Really, thank you all for joining us. Thanks everyone for watching, for dropping questions, and stay tuned for our next jam session, which should be hopefully as epic. We'll make sure of it. Thanks, everyone.
Fun.
Thank you.
Bye.
Thank you.